Phil, big day. We just got
Hey man,
our first rate cut since 2020.
big news, big news. It wasn't too much of a surprise, the West kept secret, but it's finally happening,
I,
man.
I think recently it wasn't too much of a surprise. Like the market really started to price this in the last, 1 or 2 months.
Yeah,
But
yeah,
actually, to a lot of people, there was still a lot of talk about, no rate cuts in 2025. They're still going to be very hawkish. And
mm,
even ourselves, what we did was we actually released our 2025 predictions in December last year. And we obviously shared it with our followers, our community. And we're a part of a few property forums as well with a lot of high net worth individuals. We shared it there as well. And once we shared our predictions, our base case was a Q1 rate cut. That was our base
mm,
case.
mm.
And we actually got a lot of negative remarks around that prediction. And these are people obviously in the property market, economists, or very well versed in the space. But basically, they were just saying that they didn't believe inflation's come down to a realistic level. And while
Yeah,
I do think inflation is still not solved by any means,
yeah,
there's more factors than just inflation and CPI readings to, allow for the RBA to, signal rate cuts. Right
mm,
now, you're looking at our economy fairly weak under the hood. Like we're in a per capita recession. Most of the jobs being created are actually government jobs, not really from the private sector. So there's a lot of kind of underlying factors that help them make this decision today. And
mm.
overall, it's not like, today 25 bips get cut and we're seeing borrowing powers, skyrocket. Everyone can, spend X amount of dollars on property and buy everything. But it's more of a consumer sentiment play. I think it's all about the market has its first rate cut in 4.5 years. And, we were kind of conditioned to increasing rates from 2022 with no end in sight. So many properties have become more unaffordable because while rates have risen, property prices have also gone up. And now
Mm.
we've got the first rate cut, so people have more confidence to come back into the market. Consumer sentiment's been at like, decade lows since 2023. And now
Mm.
we've finally seen that number pick up, which means even though people, might not have significantly more borrowing power, there have been a lot of people on the sidelines just waiting to get in. And
Yeah,
now those same buyers have the confidence to enter the market today, knowing there's no more rate rises, knowing that we've started the cutting cycle. Obviously, this won't be as aggressive as 2020 COVID level, but at the
mm.
same time, what we're going to see is interest rates drop, 75 to 100 basis points, most likely over the next 12 to 18 months. That's going to,
Mm.
ease conditions, and that confidence will, spur a lot of demand. What are your thoughts, man?
Yeah. You're exactly right, man. I agree with everything. And another thing is that's really scary is that why I think a lot of economists and people in the space, especially in the property space, are worried is prices are going to jump up now.
Yeah.
So now people are like, and as you said, all those people that are in the sidelines, they were thinking, look, man, we've seen Melbourne go down, we're seeing prices slow down,
Yeah.
listings are starting to stretch out. Maybe let's wait it out a little bit more. And now that there was basically certainty that there was going to be a rate cut almost people are starting to kind of jump into back into the market and gain more confidence. And the thing is like inflation is still pretty high, right? Things and when you go to Woolies and Coles, it's still really expensive, right?
Yeah.
Employment rate is actually pretty good, like historically, right? So
Yep.
it's not actually too high. And
Mhm.
but the thing is, what makes it even more complicated is there is just so much going on around the world, and
Yep.
there's so much going on in a sense of, like the tra tariffs that are going to happen in the US across how is that going to impact us? Apparently, it's going to impact direct markets in Australia, like our steel and our minerals as well. So maybe this is, and also what the sentiment was with the government is like they need to get the interest rate, and might as well get it done now because if
Yep.
they leave it too late, they might give them less room for the RBA to actually do anything, and then they might be forced to make drastic changes and huge cuts. So I
Yeah.
do think there is definitely positives and negatives, right?
Yeah.
As a whole, it probably is a positive, and it did need to start coming down, especially everywhere around the world has already started doing that.
Mhm.
But the complicated thing is we didn't jump up our rates as high as everyone else did.
Yep.
And so it's probably going to be likely that we're not going to be cutting as quickly as everyone else was as well. Yeah.
100%, man. And if you look at just, you mentioned a few things about inflation levels and things of that nature. Yeah, that's why they will, to your point, be more cautious. And I was always saying, I think there's going to be a very hawkish cut, which means
Yeah.
that, yes, they'll reduce interest rates, but they're going to be very data dependent moving forward. They're going to look at all the readings from a CPI perspective, look at the economy, look at the wage numbers, job numbers, everything else to make more decisions. But
Mm.
it's interesting because it's also an election year. So
Yes.
with election year, with that kind of, big event towards the end of the year, which can be very driven with, by political parties to, get more votes, etc. I'm not saying anything, not trying to say anything by any means, but at the same time, those factors always have some kind of influence on the RBA for sure. And I think
Yeah,
if they do want to, cut a bit more aggressively or play to, certain people's hands, they have to do it before the elections really come into play to make it look like they're not trying to be involved there at all. So it's
exactly.
going to be very interesting what happens this year. But I definitely think you're right. I don't think we're going to see, any aggressive cuts by any means. I think they're going to be fairly cautious. If you do see more than three cuts this year, I'll be very shocked myself. But again, it's all just the start of this next cycle, which is very crucial. Like, if you talk about, who's the real winners and losers here, I think obviously if you own property today, if you've entered the market, great, because most likely that property is going to continue to do very well. If you're about to get in the market, I would again speed up that process. There's a bit of urgency now, especially if you're buying certain price bands, certain locations. If you are looking to, secure an occupied home like Sydney, Melbourne, more unaffordable pockets, those pockets will probably see a bit more demand coming in today. Whether those prices will grow, these are unaffordable rates, I don't know, because 25 basis points isn't really going to drive the needle too much from a property price 1.5, 2.5 mil range because of the fact that they already might be a bit unaffordable. But it's all about, again, who is going to benefit the most. And I truly believe if you're looking to kind of enter the market and take advantage of these cuts, and if you are, looking to experience a lot of growth for your property purchase, speed is crucial because demand
Yes.
will definitely increase from first-time buyers, from investors who want affordable properties, and people who are very
Mm.
data-driven into, affordable locations with very low supply. There's already a lot of buyers there right now. Like I'm talking, up to 50, 60, 70 buyers per property. And now
Yeah.
we've got more demand coming in. So that's going to really set fuel to, price growth in certain locations for sure.
And who can really get hurt is that bottom market, right? Because you're
Yeah.
going to see those jump up the most and the quickest first, because they're going to be the ones that people can enter in and get into the most. So what you might see is actually, yeah, everything might seem good in terms of repayments, you're paying less interest, but you might be actually less competitive in the market because
Yeah.
that bottom has all of a sudden risen, and all of a sudden now everyone has just jumped up kind of like another level. And the tricky thing is with the RBAs, they have to balance their power between cutting too much and not cutting enough, right?
Yeah.
And with what you were bringing up about the election as well, which is really, really probably one of the biggest factors of what they have to think about, is they don't want to be seen as favoring one side, as you said.
Yeah.
And also, yeah, they got to be controlled in how they actually be able to actually reduce those rates because they don't want any drastic changes to happen in the economy either, right?
Yeah.
And yeah, that's basically like. And
Yeah.
what else? What I was gonna say was with the rate, the more that they actually being able to actually sorry, I lost my train of thought. So what was the last bit that you said? I was meant to
Or
actually.
it's more
Oh,
about affordable properties, like this the demand
yeah.
already coming into the market, which
Oh
you've seen
yeah,
over
yeah.
the years.
Yeah,
Yeah.
with the affordability, sorry, what I forgot to add was another thing that the politics side is doing is creating new laws. So I don't know if you've heard about this, and we might have spoke about it briefly, is about
Yeah.
being able to reduce the hex and not
Yeah.
include hex. When we have these new initiatives that governments are bringing up, that even if they actually don't come into fruition, the emotion starts to take over. And that could
100%.
be for people that are owner occupiers, that could make it more competitive for them because you're versing more emotional people because they might say, look, I might stretch myself now because the government said that they're going to make HEX not factor into my payments when I go for the loan so
Yeah.
that I'd be able to afford it or whatever that may be. So that could be something that people can, lose themselves of and not to get too emotional. So that's one thing that I would always bring up as well.
Yeah, and I've been hearing more and more things about, more flexible financing options for first-time buyers or people trying to get into the market. So Hex has obviously been one of those initiatives that they could definitely implement and make sure that, people can borrow maybe up to, I was reading an article, up to $96,000 more. We posted about that as well. Another thing they're looking at is people actually being able to access their super to buy
Yeah,
property as well. And I'm a bit torn on that because it's meant to be for first-home buyers, but if you look at the amount of super first-home buyers have in their accounts, their balance is fairly low. But if you
yeah,
look at a lot of people about 40, 50 years old, they might have hundreds of thousands of dollars in the super. So that could
yeah.
still maybe positively impact, seasoned property investors again. So some of these are a bit questionable, I think personally, but at the same time, what they're trying to do, because they know once they cut rates, prices will go up. And the RBA
Yes.
actually had a warning, an urgent warning for the market last year on this exact train of thought that if we do cut aggressively, we're actually going to cause, property rises to rise significantly, and it's just way too unaffordable across Australia then. And that was one of
Yeah,
the main worries, and that's why they're thinking about these measures. But if I'm a everyday Australian and I'm looking at these, measures coming into the market, I'm thinking I need to act with speed, pretty much. I need to
yeah,
make sure that I have a plan to get into the market, have an understanding of where to buy, because we're not seeing anything stopping prices from rising anytime soon, in my opinion. I can't see it yet. Severe
yeah,
supply shortage, crazy demand, which is going to increase a lot from today. And now
yeah,
we've got, even more flexible lending options. And I've also just been checking my X feed in the background. A lot of banks are passing on this rate cut, which is great. What that
yeah,
means is, again, like RBA, if they reduce interest rates, it's not necessarily the banks do the same, but the banks have passed it down. We were talking about this before. We were always saying banks are likely to pass on the first one or two cuts because it's just been historically high for a very long time. And I
yeah.
think that's what we're going to be seeing again, at least for the first one or two rate cuts, we'll be seeing banks implement that, which will help real-time financing as well.
And to your point about the flexible lending
Mm.
ways, now because of that, and with rates going even lower, more people are actually more competitive, especially in the
Yep.
super space. Because
Yep.
super was been one factor that has been really expanded to what banks can actually accept. Some of their policy has been completely changed, and also the regulation has changed a lot too. So
Yep.
all those people that, as you're saying, with their super, with those rates going down, it will go through a lot sooner. And another trick that some banks try to do is, as you're saying, banks usually do pass on their rate, but not always.
Yep.
So we're seeing some of these smaller lenders offer some ridiculous rates,
Yep.
right? Just to steal customers. And
Mm.
what that happens is people can get trapped in a really low rate. And when the rates go down, people just assume that their rate will go down. But
Yep.
with these lenders, they might take a loss in that first year with you for a
Correct.
rate that's not really profitable.
That's
And
right.
as the rates go down, it won't change at all.
Yep.
And then happens is 3, 4, 5 years go down the line, you've heard, okay, well, my bank was the best at market at that time. We've had all these rates. I don't need to worry about it. But what's happened is now that's actually the most expensive one. So
Yep.
now with the market changing so much, it is really critical between balancing a rate that might be really good with a bank with high fees, or I've just refinanced over. If I have to refinance again, are the costs really benefiting this rate because my bank has already passed on the rate? So it isn't something that you can just do blindly just because your rates have gone down. Let me just find that bank with the lowest rate. Obviously, it's between us to find the best rate, and obviously for you to find that property that will obviously continually to grow. So it's not as simple as, okay, everything is going up. Let me just buy whatever. There is definitely more margin for error, but that doesn't mean that you take more risks either.
So true, man. I love these golden nuggets of information. Like they're so valuable. And I was just going to ask you because financial strategy now with rates, going down so aggressively over the next, 12, 18 months, it's not going to be the same for everyone. People
Yeah,
are going to need to look at different lending options, different interest rates, different policies as well.
yeah,
Very
yeah,
good example. We were working on a few clients together where they're refinancing their own occupied home to buy an investment property, taking some cash out and leveraging that cash in the market today. We're actually looking at fixed rates versus variable rates in that scenario.
mhm,
So going on
mhm.
fixed rate for a 1 year time frame, they can cash out $200,000 from the owner occupied property, use that 200K in the market. So their loan for the owner occ has increased by 200K. But because we're going to fixed rate for 1 year, their mortgage payments are not even changing, or it's a
Yeah,
very minimal change. So it's not
yeah.
impacting the lifestyle, and we've got a way for them to buy another property. So what are your thoughts about, effective financing strategies during a rate cutting cycle? What kind of, insights would you give? I know you gave some really good ones already,
Yeah.
but anything
Something
else?
like that is perfect. That example you used is
Mm,
perfect, right? Because some of these fixed rates, what we have to balance is the RBA going to go lower than what the
mm,
actual fixed rate is? That's obviously going to be the number one. We don't have a crystal ball, but we
yeah.
can maybe think about it, right? If a bank is offering a 1% lower fixed rate,
Mm,
realistically, do we think that it's going to go down 1% within a year? Probably not, right?
right.
So
Yeah.
maybe it's good to fix it, right? And
Mm,
then with the example that you've said, you've now got a set payment that you've got to do. And if your business needs cash flow or you need to purchase, if you're looking to purchase another property, you've got guarantees in a market that's already going really crazy right now.
yeah.
So at least you've got something to send to yourself. When you start looking at the 4, 5 year range, I think right now it might not make sense just because we don't know enough of where the rates are going to go. Right?
Mm,
How low are they going to go, or how much lower are they going to go up higher, or how is the market going to react? There's just too much variables to kind of guess
yeah.
4 to 5 years. But with a smaller time frame, depending on what the client needs, it does definitely work. And we can always, split it and have half variable, half fixed. If you
Yeah.
feel more comfortable with parking all your money into the variable rate or your savings into that, and
Mhm.
maybe just having the fixed income where you've got some sort of guarantee, it worked the opposite way when the rates were rising, right? It was
Yes.
like,
Yes.
well, look, these fixed rates are really good right now. Let me just lock it in now. But because we didn't know how high we were going to go, maybe let me leave a little bit variable just to kind of take that
Mm.
risk on. And it's obviously not us to tell you. Everyone
Yeah.
has their own goals and lifestyle and how much that matters to you. But obviously, we try to look at what you're actually looking for before we can just say, yeah, do the first year. Because also, banks might offer you a good fixed rate, but your variable rate might be really bad too. So maybe overall, it might not make sense for you in that way either.
Yeah, 100%. And because there's so many options, so many lenders, so many
Yeah.
different strategies, like we always urge people to, have a consultation with us. And
Yeah.
obviously we're very flexible. We do that free of charge as well. We let us understand your scenarios, your goals, what you're trying to achieve in the market, because there's a million ways you can get there, but doing it the best way forward, the most cost-effective way, not impacting your lifestyle, making sure you actually achieve whatever you're trying to achieve in a very easy manner is not
Mhm.
always, available from every team you approach. So we want to look at every single aspect. And I think even now from lender perspective, there's going to be a lot of competition for sure. In a
Yeah.
rate cutting cycle, to your point, it's very different when the rates are rising. But when
Mm.
the rates are going down, people are trying to get ahead of the market to get the business, get the share of the market coming towards, themselves. So they might be a bit more competitive. And then it's all about understanding the strategy of the time frame. We might use a more competitive loan to make sure our clients aren't impacted as well. So there's a lot of different strategies. And yeah, definitely, yeah, booking a call,
And
man,
as silly
because
as it
it's worth
sounds,
it.
banks take turns being the best. And it basically happens in
Yeah.
most of these industries, right? One bank will be super aggressive in the market. Like, for example, right now, Suncorp is one bank that's been
Yeah.
really, really aggressive in their rates. And they take turns. Last few months, it was a different bank that was offering rates that they can't really offer right now. So
Mhm.
they do try to, as you said, gain market share and win market share. And the best thing is for the consumer, right? Because
Yeah.
more and more loans are going through different banks and through mortgage brokers.
Yeah.
That means we have more options. And with the looser lending strategies, that way we're able to really choose the best bank and obviously look at that first year and then on, not just that first year.
Of course, yeah. It's not always about, the policy right now and the interest rate right now. Again, it has to suit your strategy for the long
Yeah.
term, your
Yeah.
portfolio, whatever it may be. It needs to all align together. It's one massive piece of the puzzle. So that's very crucial. Have you been getting a lot of inquiries from your current clients about refinancing strategies now that, rates might be dropping in the last few weeks? Have you been, seeing more demand, more demand from a loan perspective, applying for
I'm
new
seeing a
loans
lot
in the
more
market?
confidence right now.
Yeah.
A lot more
Yeah.
confidence. That's what I'm seeing. Like
Yeah.
clients are really more hungry, I feel, and
Yeah.
a sense of urgency of trying to actually get into the market.
Yeah.
Uh, Previous to that, as you were saying, people were on the sidelines and thinking about it. Now it really feels like people are trying to buy because whatever the rates are going to go down, immigration is still rising, inflation is
Yeah.
still high.
Yeah.
There is nothing saying that any of our prices are going to go down.
Yeah,
And
man.
it's
Yeah.
look at a place like WA, the government is begging people to go there. They're literally giving tradies 10 grand just to move there, just because no one is building houses. Like we're
Yeah.
still, I thought you did a great post about it. We're still so much below our actual yearly targets of actually building houses. And
Yeah.
that's a really, really big factor that's not being talked about.
Yeah.
With these lower rates, hopefully that will mean potentially lower material costs, maybe lower labor costs, maybe it's cheaper and easier to build.
Yeah.
That could potentially take some stress out one way, but it needs to be a bit more than 0.25. We're not going to really feel that.
Of course. Yeah.
But we're still going to see those really high prices. So supply is not really going to change
Yeah.
in the short term, anyways.
Yeah, I asked that question as well too because I've had so many clients that we've had, our initial consultations since December last year, and
Yeah,
a large proportion of them are still on the sideline today. They've actually messaged me individually saying, "Look, I'm actually waiting for the rate decisions. I'm not
yeah,
sure about these tariffs
exactly.
and those kind of things."
Yeah,
So this
yeah,
uncertainty is always going to be there. But when you see a monumental event like today, when you're basically guaranteed lower rates 12 months from now, 18 months from now, those people will come off the sidelines for sure. And
yeah,
that will definitely increase the amount of demand. And like we're talking about, the fundamentals for growth are so strong. And you made a really good point about, inflation remaining high here because when you look forward and you see where inflation is going, people are talking about inflation decreasing and things of that nature. You're actually looking at inflation just increasing at a slower rate.
yeah,
Inflation was increasing like 5 to
yeah. It's not
9%
going
per year.
down.
and now
Yeah.
it's going up at 2%. So prices for everything is still going up. But
Yeah.
that's where if you leverage your money because the value of the dollar is still declining today, you put those dollars into hard intrinsic assets like property, they are hedges to inflation long term. So you've
Yeah.
got strong fundamentals for property price growth, value of dollar is still declining significantly. So it only makes sense to use your money wisely here and invest in those kind of assets. So that's why we're very bullish on property long term, despite whatever interest rates do, because inflation, unfortunately, those prices we saw 5 years ago are not coming back. And I just
Never.
think that's a hard fact that people have
Yeah.
to kind of accept now. And that cost of living crisis might be more permanent than you think.
Yeah. And to your point, right? Like the prices, they're just gonna like keep rising. And as the supply goes down, everything is just gonna be more and more competitive. So
Yeah.
it really is turning into more of a like a monopoly, it feels like for some
Yeah.
people, right? It's like a
Yeah.
game is of how much land can we actually kind of purchase. And what's the point that you're saying with so much uncertainty in the market, and what's, the ironic thing is Australia is probably the least uncertain if you compare
Yeah.
us to the rest of the world, right? So our properties are just like, even if you look at the actual building standards, like I was in the US on holidays, because of their natural disasters, the way they build houses is very different. We have really nice houses, really nice brick homes, really well built. We don't really have natural disasters. We don't really
Mm.
have any country that wants to have any war with us. We have limitless minerals, right?
Yep.
And the big thing is like immigration. People want to come here. People want to live here. Europe is declining in population, whereas we're like rising like crazy. So
Straight up. Yeah.
all these factors are just proof that even if the world crashes and the market crashes, even if you look at a house, we can guarantee, I'm sure you can guarantee a 5% yield without even trying, right?
Yeah.
And that already beats inflation just there.
Just right there.
So even if
Exactly.
we completely ignore all what I've just said, let's just ignore all the fact that the highest prices are going to go around, you're going to get 5% back if you buy a house. So why,
Yeah. Yeah.
right?
I was looking at past data because a lot of clients were wondering if there was like, any global recession, anything, slowing down the economy from a worldwide perspective, what's going to happen? 2008 GFC, Australian property market as a whole on average declined 10%. It then recovered within 12 to 18 months. So obviously you're going to have corrections as you
Yeah,
move across, these kind of, unfortunate events, but they're not going to last for a long period of time
yeah,
because the property market, real estate here is a backbone of our economy. That's the
yeah.
bottom line. And what are your forecasts for the interest rates next, let's say, 24 months?
I think we this year, I think there's probably two or three left
Yep.
at a
Same.
minimum,
Yep.
right? And then maybe next year there will probably be one or two, but
Yep.
it'll really be dependent on where the actual economy goes. And in terms
100%.
of sizes too, I don't see a 0.5% happening. I
Yep.
don't think we'd ever need to have something like, I think it'll be a gradual fall because we've done well going up and our economy has done well and we're pretty distant to other places. So our
Yep.
economy is a little bit different. So I don't see any big ups and downs. So
Yep.
I think it will be like consistent.
Yep.
But it will really be dependent on also now in 2, 3 years time, 4 years time now, the Olympics is starting to come close. So now we have to think about what that kind of impact is going to have
Yeah. Yeah.
and all these
100%.
other world, and we're getting more and more sporting world events coming to Australia too. If you've noticed, I'm a big UFC fan. We're
Yeah.
getting like much more UFC. The F1 is, always
Yeah.
going to be here, Oz Open, obviously, all the standard stuff. We're actually hosting a lot more celebrities, a lot more concerts are coming here.
Mhm.
So a lot, and
Drake's in
also,
town.
yeah, yeah. And you even saying it last time in Melbourne, it's going to be one of the biggest, we're aiming to be one of the biggest populations in the country.
Yep.
So all these things make Australia look really, really confident
Yep.
that no matter what, these properties are going to go up. They might decline. There might be something that happens maybe 1 or 2 years.
Yep.
But these interest rates are going to go down a little bit, but they're not going to go. I don't think they'll ever go back to what they were, previous.
Of course, yeah.
If
You're not going to get COVID levels again for sure. I agree
I
with that.
don't think
Yeah.
so. Yeah,
Yeah.
yeah,
I'm very much aligned to what you're saying. I think the cash rate will settle around 3% in that range,
yeah,
somewhere in that
yeah,
range. And put it that way, if the cash rate settles around 3%, what you're getting from the bank might be about 4.5%. So you're buying properties today, getting net 5% rental yields, which will be positively cash flowed in like 2, 3 years' time. I
yeah,
think that's a massive factor which a lot of people are overlooking because these properties are growing double digits per year and they're going to give
yeah.
you passive income in a few years' time. There's no reason not to, kind of diversify the portfolio and look at that asset to make
Mm.
sure that,
And if
you're growing your wealth.
Yeah, and I don't see rents going down either. So
No,
if
no
rents are
chance.
going to continue to increase and increase and increase, and rates do so, as you're saying with this, you
Yeah.
have a lot more options when you start positively gearing your properties. And if you get into a property now, right, that's really cheap, and that's going to blow up in the next 2 years, and then it starts becoming even more positive in that 2 years, you've got a good foundation to get whatever
Yeah.
you want.
Yeah, I truly believe that 2025 and 26 will be like generational wealth making opportunity
Yeah,
years.
yeah,
Because I think the gap between your upper class, middle class, and lower class is going to widen significantly. I think middle
huge.
class, with the way inflation will definitely keep rising long term, is
Yeah,
going to be wiped out to some extent. And I think you'll
yeah,
have like your top 5, 10% of wealth in a certain basket, and then everyone
yeah,
else like lower class, just because
yeah.
there's no kind of way asset prices like we are talking about are going to be declining for a long period of time. Corrections
Mm,
happen, but long-term trend is up. And that's
mm,
why it's so crucial now to, act with speed, get into the market or think about getting into the market, educate yourself. But again, knowledge is one thing. It's always about people can have all the knowledge in the world. You can watch this podcast. You can, it's great that you get that information, but how you act upon the information is very crucial. So
mm.
I think acting with speed and making sure you take a step in the right direction, having it just a conversation can change your life.
I don't think you're exaggerating either,
Yeah.
because you know what I saw this week is there's $111 trillion in Australian assets in property. Our share market is 3 trillion. That's an unbelievable
It's 11,
difference.
11.1 trillion.
Yeah, oh, sorry,
Yeah.
11.1. Yeah,
But yeah,
sorry,
it's
it's triple
like
the
three,
amount,
four
right?
times X. Yeah.
Yeah, so it's like ridiculous, right? And
Yeah.
and the crazy thing is people are more confident in houses knowing that they're gonna go up over, shares, where
Yeah.
people have started to think
Yeah.
there's too much going on, there's too much volatility. And
Correct,
as I
man.
said, the rental yield, right, that we're saying 5%, the more rates go down, we've got a guaranteed asset that's guaranteeing us money. It's not an NFT, it's not crypto,
Can't
something that's actually physically there and someone needs to live in it, and AI can't hack your house
hack your
and
house.
so like it's
Yeah.
like as safe as it can be, as and it's not like being exaggerated saying this gap is going to be generational and it's going to get to a point where there's going to be no middle class in
Yeah.
maybe a generation from now.
It's a very unfortunate, harsh truth, in my opinion, but it's always
Yeah,
about, look, we don't make the rules. All we're trying to
yeah,
say is be on the right side of the equation. That's
yeah.
that's crucial.
Yeah, yeah. And there's just so much like already with one of probably the worst years for in terms of banking, right? And we've seen properties go up like crazy and people make so much money from property and so much money from the bank, right? And banks are more profitable now than ever. And
Yeah.
if the rates are going to go down and they're going to start making even more money, it only brings more attraction into the country and more money into the country. And we can start moving away from, like some place like Western Australia being mining dependent to physically just being a construction dependent of people just wanting to live there. And especially you see a lot more in regional New South Wales, this happening of I have a few mates that are, electricians and builders, and they're telling me, especially in the North Coast, there's just so much construction and so much work there. So this is just going to get, and if it gets cheaper and easier to do this, it's
Yep.
only going to make everything go more and more expensive. So
Correct.
so all I hear people getting overwhelmed saying everything is too expensive, but you just have to find the right place because there's so much opportunity out there.
Yep, 100%, man. It's a very interesting time, very crucial time. So
Yeah.
if anyone's, taken any great information from, have talking about interest rates, inflation, property, get in touch with us. It's not going to hurt. We're here to help. And we'll talk again, Phil. It's a very interesting time next few months for sure.
Good to see you, man. It's good to speak
Great
to you.
chat,
Good to see
man.
you.
We'll speak soon.
See you later, man. Good one. Thanks. Bye.